Well, hey there. I'm Terry Sawchuk. It is Thursday, so that means it's time for 3-Minute Thursdays. Of course, this is Father's Day weekend, so for you fathers out there, happy Father's Day, and hope you have a great weekend, get to spend time with friends, family, and you do lots of fun stuff. You deserve it. So let's talk about the market and some eventful things that took place this week. So the market has really bounced, and a big reason for that is, of course, and I've talked about this previously, the 10-year Treasury dropped all the way down to 4.26%. And as you can see, it's kind of a little wedge here, and it's dipped below the lower trend line. Now, that doesn't mean that it's not going to maybe bounce back up here. It could. And we'll see what happens, because this level of support, which looks around, just call it 4.2%, kind of on the low side, would be an area that we would expect it to kind of hold. And so the reason that this is important is because the market seems to be somewhat inversely related to the direction of interest rates. And if you go back to Wednesday, actually you go back to Tuesday, the market rally really started in earnest. I should say the resurgence of the rally on Tuesday, when we got CPI reports that came in well below expectations. Of course, that meant that the Fed has more room now to potentially cut rates, because inflation appears to be slowing down, even though it's still well above trend. And then yesterday, on Wednesday, we had the Fed come out and effectively make what I would say are more dovish comments, and saying that the job market might be a little overstated in terms of how low the unemployment rate is, which people have been saying that for a while, and yada, yada, yada. So, the market took that as really a bullish signal. And where we're at right now is frankly that the market, the rally seems to be intact. And if anything, on a trend basis, looks like it could be accelerating. When I look at the S&P 500, you can see that I drew some trend lines here just as kind of a guideline. And you can see that obviously it's kind of smack dab in the middle. We bounced off the lower end of the trend range, which would imply that at some point we're going to make it, maybe to the upper end of the trend range, which would take us to, potentially 5,700, which is, 300 points higher than it is right now. And so the rally continues. The research that we get from 42 Macro was very supportive of, almost a move back to this Goldilocks scenario. So as long as we get, economy that is slowing but is still relatively strong, we've got, the opportunity to keep interest rates low, liquidity high, and asset prices moving higher. And of course, it's an election year and it's a Democrat incumbent. And so, typically that in those years, they've been bullish for stocks. So it looks like, at least for now, the rally is intact. Now, as soon as I say that, it could be that next week it starts to turn around the other way. But, the evidence really doesn't support that at this time. So barring anything exogenous, obviously I don't know if you've heard about it, but it appears that there are submarines lurking along the coast of Florida and maybe the upper East Coast that officials have mentioned, and saying that they're looking for, which I don't know, it seems performative to me. But regardless, there's stuff like that can pop up where you see external hotspots that could spook the market a little bit. But barring anything like that, the economic data suggests that the market is definitely moving in the right direction, probably will continue to do so. So enjoy your Father's Day weekend. I will be back next week for another edition of 3-Minute Thursdays.